Hi, I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our Market Insight broadcast, where we give you our perspective on the week's top news stories regarding the market, the economy, and your portfolio. And with me today is our Chief Investment Officer, Aaron Tuttle. Welcome back, Aaron.
John, I am glad to be here.
Well, you know, yesterday we had one of our clients visiting who hadn't seen our new offices, and he says, you know, what I love about your Market Insight broadcast is that every week you introduce this special guest, Aaron Tuttle, but he's always the same guy. I said, well, he's not new, but he is special.
Yes, I am. As you were talking about our mission, I've decided that my mission in the Market Insight call is to get you to wear a bow tie.
Well, see, I don't know if I can. I'll have to get the clip-on one.
I mean, that's what makes me special is the bow tie.
Exactly.
Because you got the beard kind of going. Maybe you just forgot to shave.
Well, we're wondering whether or not there's going to be more spending by the federal government.
Of course there will be more spending.
$6 trillion is what we've been talking about so far with the Biden administration. Yes. That's a lot of money.
At some point, it is a lot of money, right?
I mean, I guess if you keep adding zeros, at some point we're going to talk about real money.
Is that how money works?
I think it is. At least in the fiat currency system.
That's right, that's right.
So let's talk about what's happened this week. And we're going to talk a little bit about one of the themes that we've been carrying out or following over the last few years, which is where we see this whole fiat currency, monomonetary theory ending. You know, yes. How is this going to play out over the next decade? And that's going to kind of lead into today's discussion. So tell us more.
We continually compare at least what we've gone through over the last decade and a half to the Roaring '20s. And why do we make that comparison?
Yeah, this is a really an important point, because this is kind of the basis of our theory.
Yes, and if we go back to the Roaring '20s, and we can look at the stock market, I think a lot of people think about the stock market in the Roaring '20s, especially the crash.
Yes.
As we go into the '30s. But there was a lot going on in the 1920s, and it was more than just the stock market. But really, one of the reasons that we think of the stock market is because, and one of the reasons we make this comparison is because of how the money supply was being used. We were coming out of the progressive era, and we were going into the new era. World War I had just ended. Out of that, a lot of the government spending at the time was curtailed because the war had ended, and you had a progressive era of the central banking, but you also had a legacy component of, well, when you have a recession and you slow down, you cut government spending, and you cut taxes trying to stimulate the economy.
So that's totally opposite of where we've been during the recessions, correct?
Coming out of the recession, yes. But what isn't happening in the 1920s is just rampant laissez-faire capitalism. There is still some of that there with the cutting of spending, but there's also a central bank. And we got the central bank, the income tax, and a lot of the progressive era tools were there for the government to use.
So if I understand you correctly, you're saying World War I ended, so now we're going into recession. Government is cutting back its spending, and we don't have money that's being put into the economy, so they're allowing the economy just to go into its natural recession to then recover on its own.
So the one new tool is that cutting spending, cutting taxes is an older tool. The new tool is the amount of money supply being created in the system, because we now have a central bank. And that central bank is going to operate on the notion of inflation, or measuring inflation, determining the appropriate amount of money supply based on a basket of goods.
Can you tell the audience, how did the money get into the system? So in other words, the central bank is created, and we're saying money supply. How does it actually become a dollar that's in our economic system?
Sure. Something's going on here with the slide. It's a little bit different. But we had currency that was outstanding, and there really wasn't change in the currency outstanding. It was time deposits, what we call CDs now, and demand deposits that were increasing behind the scenes. So the central bank, being the lender of last resort, was starting to increase what are known as money substitutes at the time, because there was a gold-backed system. So they were doing that. And we can see that on column 8, don't get into the detail, we can see the effect of money supply. It grew about 70% over that decade. And our statement, or our belief, is that the amount of money being created will make it into capital markets or capital assets first, and they will cause an appreciation in those assets. So out of the 1920-21, we go through the recession as a lot of the government spending for World War I ends. There is a lot of deflation in that system. So the Federal Reserve is seeing that in the index, and they begin to expand the money supply. Also, World War I had ended, and Europe was very much devastated, and they need foreign loans. So this allows the foreign loans to be made by the U.S. To Europe, and in turn, the loans are used mainly to buy exports from the U.S., specifically agriculture, because going up into the 20s, most of the population has some type of relationship to the agricultural industry. So there wasn't as much mechanization yet. They continue to increase the money supply for a lot of different reasons. I won't get into any, but the point is that we see that money supply expand, and the market actually expands right along with that money supply.
When I'm looking at your slide here, it looks like they began the money supply right when we hit almost the bottom of that recessionary time after World War I.
Right. So during that recession, they're expanding it because of the inflation measures in the basket of goods. Then they get into 1924-25. England was trying to go back to the gold standard. It's kind of a gold bullion standard. And what you need to have happen, you'll get gold outflow if interest rates are higher in other countries. So you need those interest rates lower. So the U.S. in 24-25 lowered their interest rate by expanding the money supply. In 27-28, there was some Baker acceptance component that caused them to increase the money supply. So if you look at this line, it's not a perfect slope. It changes back and forth. And what we do is we try to look at it more on a short-term basis. Now, imagine if the data that we get today is not as clean and easy to obtain in the 20s. It took me a long time to actually go get all of this data and try to shuffle it around in the same time periods. But this is looking at the annual percentage change in money supply growth.
So the annual change is quite variable.
Yes, 4% all the way up to 10% to basically 0% right before the crash. So we like to look at the money supply growth because of this phenomenon.
Well, what I think is notable here is the fact that it was when the money supply got near zero in terms of new additional money into the system, that's right about the time that the market crashed.
And we think it's causal. So if we look back into coming out of the first recession, and we can see that the money supply takes off, there's a lag, but the market takes off similarly. And then there's a more stable money supply as growth begins to slow. There's a stable environment in the market. And then we get into that 24-25 period, back when England is trying to go to the gold standard. The Fed lowers interest rates again, and we can see that lag, but it corresponds to an increase in the capital markets. They begin to stabilize for a short amount of time, and then a little bit of a flatness in the market. We get the banker acceptance issue that pops up. They really expand the money supply. And then as we're going into 1928-29, we start to see the Fed slow. It gets down to 0.7% growth rate, and then there is the crash.
So it's not a linear relationship because you have ups and downs, but if you look at it in aggregate, it seems like there's a lag.
There is a lag. Right now we see about a 6-month lag in the data. Now that could be as quick as a month. It could be as long as 9 months. There's no perfect science here. You can see that we're trying to make sense and try to figure out how best to measure money supply and try to deal with the lags. It's not a precise science at all, but the point is that the money supply was increasing dramatically, and the capital markets were increasing with that. So why not just do that all the time?
So when I'm looking at this data, and I compare that to where we are today, would we then conclude that odds are we're going to have a rising market as long as we continue to have this increase in the money supply?
Right.
So,
So why would the Fed not always have an increasing money supply then, if this causes the market to move up? There is some pain at some point, and why we're making the comparison of what we have been in as an economic environment and the 1920s. And that is, though the money supply expanded rapidly, what we didn't see is inflation expanding rapidly.
why was that?
That's the $60,000 question, right? Because the Federal Reserve was expanding the money supply based on a notion of a stable basket price, and that allowed them to continue to expand the money supply, see that capital market, but at some point the inflation showed up. But we can see here that though we had a 68% increase in the total money supply over this time period, at no point do we even see inflation above 4% whenever we measure it as a basket of goods. And the reason, similar to what we're going
Are
through.
they going back to that?
Sure.
Is the reason that they started the money supply at that time because of the fact that they were experiencing deflation, or what is the impact of the deflationary period?
So,
because it looks like
yeah, so
there was
coming-
almost minus 9%.
Coming out of World War I, there were a lot of command and control components put on the economy to provide war goods, and those were ending, and a lot of the government spending was ending. So as that economy restructured, prices were falling in many of the goods in the basket, and it hadn't stabilized yet. And the Federal Reserve uses an inflation basket as a gauge on how much money they should create to create that stable price. So if you see deflation, the Fed's response, based on their tools, is to increase the money supply. So that's why they started it at the beginning. But why do we not see, because you can see out of that 10%, they do get prices increasing. So what's happening? Well, let's go back to the 1920s and how exciting of a time it would have been. Most houses and places that people are living are getting electricity. And with electricity comes all these new labor-saving appliances, the vacuum, the washing machine, even the toaster, the ability to prep your food easily and take it with you. Another thing that's going on is instant communication through mass media, through radio. Also, you can pick up a phone and you can connect with people across the world. So there's a lot of new information, similar to today, right? We have a lot of new technology coming in the form of these phones, and they actually increase our productivity. We can work from basically anywhere now. And then speaking of working anywhere, you had more options for employment because you now have this vehicle that you can use to go further away from your home to find better economic opportunity. And this is all one big cycle because the farms are starting to get mechanized. The tractor is becoming something that farmers are using, and that's increasing agricultural output dramatically. And a lot of people are leaving the urban environment because the farms are being mechanized and they can produce food, and the higher cost producers are having to leave. But there's plenty of jobs at the factory because now all these new appliances are there. And the employment or the demand for that labor is keeping prices up. So they were in a really nice circle where it was just kind of a feedback loop as everyone was becoming wealthier and wealthier. And the production capacity of the economy was growing at a faster rate than the money supply. So that way we don't see it in the inflation numbers. But it is causing an imbalance because eventually the food prices, even through mechanization, is actually decreasing, and a lot of the money is being borrowed for the farm implements and the property, not all of which is necessarily needed. So there's going to be a lot of bankruptcies, especially whenever we start to finally see inflation and the Fed slows the money supply, and then we have the crash. So then if we are comparing today to the 1920s era, because we see a lot of similarities where There's big labor pools coming in as the Soviet Union goes away from communism, as China becomes more and more market-oriented. The amount of labor pool is expanding dramatically over the last couple of decades. The amount of technology that is making us more efficient has really kept the prices of goods very stable or actually declining, depending on the industry, while money supply has been going really dramatically growing at a faster pace than that has ever been seen. So the question is, if this is the 1920s and we're living in something like the 1920s, and we know what followed the 1920s,
will we have the same outcome?
Will we have the same outcome? Right. That is the question that many people are probably asking.
And that's really what we've been grappling with as a firm, is how do we plan for that eventuality? Because we know that this is going to have some type of end.
Yes.
But what is that going to look like? Are we all going to be dire, or is it going to be something different?
So we don't think the next phase is going to look like the 1930s.
Explain to our audience why you think that.
So one, if those that follow financial markets, I don't know why they would, but if they do, one of the things that Ben Bernanke during the 2008 crisis was on record saying is, look, they know the Fed caused the Great Depression because they slowed money supply, and they're not going to do that again. So then we get the $1 trillion bailout that was not very well received, but the market loved it, and that was because they were going to print money. They were not going to make the same mistake that they made in the 1930s, which is slowing the money supply. And we've continued on with that playbook since 2008. So we didn't get the Depression. We are more likely to get inflation. We think as this unravels, the Fed is going to be very quick to continue to expand the money supply, to even at this moment saying that they're not concerned about a rise in inflation. They would actually welcome inflation to try to offset some of the deflationary pressures that we've gone through, trying to average out to 2%. That's going to cause some supply and demand components, and we're going to see prices increase if we can't maintain this productivity gain that we've had over the last couple of decades. We're already seeing that in this scenario where there are supply-demand components. Fed is saying it's transitory, and we hope that is true, that we get back to high production. But if we don't, I think the decade following the 1920s and our experience will be more like the 1970s, where you have inflation as the outcome, not a depression or deflation.
How do you reconcile that with Janet Yellen's statements yesterday, where she was saying that this inflation that we're going to see right now is transitory? In other words, as we talked about last week, it's going to be short term, not long term, and that she expects interest rates to be low for much longer.
Well, the day before, she said the opposite, so that was her reversing her statement, and we saw the market sell off from the previous days. So it was more of her backtracking some of the things that she had said before. But nobody knows. The central bank doesn't know, the market doesn't know if it's going to be transitory or not. And we see a lot of concern showing up in companies about the prices. In Warren Buffett, during their quarterly update and letter and commentary, they were talking about significant price increases that are able to be pushed out on the market. So we're seeing a lot more evidence that, whether transitory or not, we're seeing that spike in inflation. We don't know that it's going to be transitory. Once again, if we have an increase in productivity, we could kick this can down for quite some time. So
the question then becomes, how do we plan for our clients knowing that this is going to be happening?
Well, we certainly monitor the money supply.
Yes.
Because to see that growth, what our clients are concerned about with our management is that we're trying to control the risk of a downward market movement. And if the money supply is increasing, whether inflation is there or not, more likely than not, capital assets, especially equities and commodities, are going to do well. What won't do well would be fixed income. It's a deflation whenever you want to go to fixed income, and we don't see that as a trend that the central bank will allow to happen, because if we see deflation, they're going to increase the money supply even more dramatically.
Assuming we fast forward 10 years from now, the same way as we did in the roaring 20s, what would you expect to be doing well and not well at that time, assuming that we have a deflationary period, just like an inflationary period as you're projecting here?
A deflationary, continuing to add into technology, which is, it's a cycle, right, that actually helps perpetuate that productivity gain. So things that do well that's further out in time are the ones that are going to benefit the most. So if your earnings are further out in time, you're going to benefit more. We don't know whenever the inflation gets to a point where it's so painful that the Fed begins to slow the money supply. And then that's whenever this would unravel. So we're just going to continue to monitor that money supply to see when that signal happens.
I think the thing that people are generally afraid of is, wow, what if we're not really on top of this and all of a sudden we have a 50% drop in the market? What's that going to do to my ability to sustain my lifestyle? Well, this is where I think it's important that there are two different things that we do. One is the management of the investments, because we're working on a momentum basis. So our strategy will push us out of the things that are not working into the things that are. So that's one thing that actually we know from our historical use of this strategy that does help. But then there's the planning aspect.
Right.
How are we going to organize our other assets, such as cash or spending? And those will be more planning concepts. So those are things that we'll be talking about as time goes on, as we start to get closer to this time frame.
I think Christina was the author of a recent blog post on how we determine that cash balance for clients, and I think that was recently released.
Yes, it just came out this week, in fact.
So continue to look at our themes. Our inflation risk is high. Certainly at the current environment has been proven accurate. We are seeing that inflation really start to show up, whether it's transitory, meaning short term, or it's long term. It's still way too early to tell, and there's arguments to be made for either. But just as much as the market doesn't know, neither does central banks or those that have been at the central bank. It's a phenomenon that's just too difficult to actually be correct on. There's just a lot of moving parts. We continue to favor U.S. domestic equity. A lot of it has to do with demographics, which we talked about a few weeks ago. Continue to favor technology, though if interest rates move up and inflation is starting to show up, this area may have a transitory pullback, and we've seen that, especially since the first quarter. We saw a value rotation. Last month, growth dominated, and then at the beginning of this month, especially fearful of Yellen's earlier statements where interest rates may move up, that we saw that value rotation come back on while commodities were moving up. So that those themes are starting to play themselves out in the market prices. And then residential move from large cities to urban, more rural, more red states. We were talking before we were live about the impact that there's a lot of empty residential spaces in San Francisco and New York, and they don't have them built elsewhere. That's probably what's causing the price of lumber, copper, and other things to moving up. And if we look at the market, near highs, we think that will continue to stay near highs. If we did have a correction, the first stop would be around 4,000 on the S&P 500, and there's a lot of support below there. And we know if we did see a sizable correction, those infrastructure bill and other spending that's right there ready to go in Congress, as well as the central bank or the Federal Reserve, they're going to act quickly, so we would see those as buying opportunities. When we look at technicals, S&P has actually given back a little bit from last week. We can see some of those smaller size companies moving up, as well as commodities moving up above the S&P 500. But at the time being, the S&P 500 or U.S. domestic large cap is doing better than most of the other asset classes, especially those that are outside of the U.S. So that would conclude our talk.
That was great information, and it'll be very interesting to monitor and continue to comment on this roaring 20s versus the roaring 2020s and what we see the outcome eventually going to be, and some of the moves that we're going to recommend to clients as part of their financial planning as well as what we're doing in the investment committee. So as always, we thank you for joining us again today. Our goal is to give you our perspective on the market and the economy based upon data, analysis, and economic theory. We have an amazingly bright team of CFAs in our investment committee that help us to make sure that we're monitoring your portfolios. And as always, we want to make sure that we're not a secret.
That's right. So click down on that arrow and share it with your friends. And don't forget to subscribe while you're down there. And if you like this, please click that button that letting us know that you like this call.
And if there are any other questions and things that you'd like us to address as part of the weekly market insights, please contact us. Contact your lead advisor or your service advisor and let us know. Or if you have questions about your portfolios, we'd be happy to talk.
Visit our website while you're there. You can also request a demo on the website, as well as see a lot of the commentary that we were talking about earlier.
Yeah, I think that's a great point, because one of the things that we've been doing to try to be even more relevant to you, our audience, is to have improvements to our website. So we continue to add content, video, and written content that we believe is relevant to your planning and help you to make actionable decisions about your money. So once again, thanks for joining us today, and we look forward to having you again back next week, Aaron, because you are special. So you're a special guest for sure. Thanks again, and we look forward to seeing you next week.